Good morning, good afternoon, and welcome to today's webinar entitled How to Maximise Long and Short Portfolios Without Getting Crushed. My name is James Williams, the Editor-in-Chief at HedgeWeek, and I'll be moderating today's webinar. Very happy to be doing this. In this webinar, which we're hosting in partnership with Refinitiv, a London Stock Exchange Group company, we'll discuss how equity long-short managers, both systematic and discretionary, might best navigate the markets, which certainly looks set to remain uncertain, and certainly over the next 12 months, and really try to avoid any pitfalls in their stock selection process. During the webinar, we'll split it into three sections. We'll take a look back at 2020. We'll take a look at where we are this year, and then we'll look ahead for the next 12 months. Certainly for active stock pickers, it's been a period of dominance by growth stocks, driven largely by the tech behemoths that really are now dominating the S&P 500. So this has really led to a period of growth outperformance at the expense of value stocks. Last year, classic value models factors largely became obsolete. But is this dominance of growth now coming to an end? Have we gone past peak earnings growth? And if so, what should equity long-short managers be taking into consideration as they look to optimize their portfolios? So very much looking forward to doing this discussion today with a very esteemed panel. We have Tim Gollmer of Refinitiv. We have Farian Amir Ghassemi of Epsilon Asset Management, and also delighted to have Julia Bonafide. Julia is at Rosetta Analytics. And Julia, I'd like to begin with a quick intro from you, please, and before we go to Farian and then Tim. Thank you.
Good morning, James, and thank you for having me on the panel today. My name is Julia Bonafide. I'm co-founder of Rosetta Analytics. Rosetta Analytics is an asset management firm that uses advanced artificial intelligence, specifically deep reinforcement learning, to manage investment strategies. So our model is actually making the decisions. I spend my time navigating the investment process as well as the scientific research that we do for our models.
Excellent. Thank you very much, Julia. Good to have you on board. Farian, nice to see you there.
Likewise. Good morning from the East Coast. My name is Farian Amir Ghassemi. I'm the co-founder and CIO of Epsilon Asset Management. My partner, Michael Perlow, and I founded the firm, in the beginning of 2017. We are a systematic domestic equity manager with what we would think is a relatively novel strategy. We effectively apply aggregation algorithms akin to, the methods detailed in super forecasting, or, colloquially referred to as wisdom of the crowds. We do that across the disclosed positions of thousands of fund managers. The idea is to create investment factors that effectively ape the foundational skill sets of active managers. Those factors aren't quite on the same axis as value growth, which we're going to discuss today. Prior to Epsilon, we kind of incubated these strategies specifically for multi-manager hedge funds as well as institutional allocators.
Super. Thank you very much, Farian. And Tim, nice to see you, and great to have you on board.
Oh, nice to be here. So I'm Director of Fundamental Research at Refinitiv, which is now part of the London Stock Exchange Group. I'm based in San Francisco, and I work with a group of quantitative analysts who build and backtest models and analytics. And I apply that in a way that a traditional fundamental investor might be able to do.
Super. To the audience, well, as I say, over the course of the next 40 minutes, if you have any questions on anything that you are hearing, please do post them, and we will take some of those questions during the course of the discussion rather than maybe waiting at the end. So I think do feel free to post anything. we will address those questions during the discussion, and I want to make sure that that you are getting your answers, you're getting your questions answered, and obviously making sure that you feel part of this discussion as well. So let me kick off by starting with you, Tim. As we look back at 2020, as I said in my introduction, it was a period of real dominance for growth stocks. What did the data reveal to you there? What would be some of the key highlights that you would make as we look back at 2020?
Sure, you're right. Last year was one characterized by the complete dominance of growth stocks, and the underperformance of value stocks. And we have a number of valuation models and factors that we watch, and all of them performed horribly in 2020. The only thing the market cared about was growth. Refinitiv is all about data and analytics, so I couldn't resist bringing some to our discussion today. So I'll show you a couple of slides to illustrate that dominance. Hopefully I'm able to share my screen here.
Yes, I can see that.
Great. So here I'm plotting using our DataStream product, the performance of the Russell 1000 Growth Index, and I'm subtracting the amount of performance in the valuation, the Russell 1000 Value Index. So where the line is above the zero axis that I've rebased to, that's where growth is outperforming value, and that shows the magnitude of it. It's one of the more alarming charts I've seen recently, as a strong believer in reversion to the mean, at least eventually. So you can see here in February 2021, it peaked well above the level that it hit back during the dot-com bubble. So if you believe in reversion of this mean, this exponential outperformance of growth versus value, could be a cause for alarm. It's not just a US thing. Here I'm looking at MSCI World Growth minus Value. If anything, the peak is even stronger. So again, the only thing the market was concerned about last year was growth stocks. Since peaking in February, we saw value make a comeback. There was a reversion there. So it reversed for a while until about March, April, May here, where you see the strong reversion. So again, growth stocks have dominated, in more recent periods.
Farian, what just looking at just the magnitude of that chart that Tim was just showing, any thoughts on how that factored into the way that your models were performing last year, and what you need to be mindful of in respect to how that growth versus value dynamic really seemed to accentuate last year?
Yeah, I mean, a few things just to set the table. Going into the COVID shock, I think we were in, what I would call Groundhog's Day, in the sense that we've had these seemingly loops of growth outperformance. I think 2013, 2017, 2019 were in some ways similar to the last 9 months of 2020, albeit maybe not at the same order of magnitude. The symptoms were worries about rising rates. We had the taper tantrum, you had 4Q18, some indigestion and volatility. We had this ETN blow up complex. And we had, investor incredulity regarding valuations. Obviously what broke us out of that dynamic was the COVID shock. And before talking about that long-term trend, let's remember that in March 2020, growth was not very much in vogue. Balance sheet strength was what was fetishized. And during that period, there was a yawning outperformance between, companies that otherwise had strong balance sheets versus those with weak balance sheets. And, in large part because analysts were scrambling to understand, the viability of various business models, not only, travel and hospitality. There was the dash to underwrite zero revenue viability, debt covenants, systematic riskiness, the capital raises prior to the cavalry arriving were, quite onerous, and OAS had, definitely blown out. So, obviously after, we had this stimulus, we had this push from offline to online acceleration, which were all tailwinds for growth. There was quite a bit of, indigestion volatility, and seemingly we're back, again, with that Groundhog's Day dynamic to the same paradigm. Now, currently, I think investors are worried about how stretched these valuations have gotten, how stretched duration can get. And I think we'll talk about that as it pertains to portfolio positioning. But I just wanted to clarify the fact that, outside of the long-term trend, there were these periods where, the buck could have turned completely differently if it wasn't for, what is largely fiscal monetary intervention.
Julia, I wonder whether you'd like to come in here, just sort of what Marianne was saying there, that there has been so much, intervention from the Fed, from all, from global central banks really over the last 12 months to really support the economy through this lockdown, and just ensuring really that there were no systemic shocks really, and we haven't really, it was an incredible recovery, wasn't it, from March, April last year. It was a V-shaped recovery, which I think the speed of that recovery is a real in stark contrast to certainly what we saw in 2008. But I just wonder, Julia, what your observation would be on what you were seeing in the market last year.
Well, largely the same dynamics. As I said, Rosetta's model is entirely data-driven. We use a neural network to create our signals, and for those on the panel or on the call that haven't worked with neural networks, they are particularly adept at measuring nonlinear information. So in data sets, and the deep reinforcement learning model itself is very adept because it's a multi-stage optimization framework that is both sequential, long-term and short-term in terms of how it trades the signal. And if you go back to Tim's chart, you'll notice that having growth and value, or value in particular, in and out of favor at various times, being able to adequately capture that behavior as well as to trade it in a timely way, that is what the model is set up to do. And what was very interesting about the market at that time, and it's actually been happening since the great financial crisis, is the truly historic decline in treasury yields, which is funneling much of this growth. And so it distorts the market. When the Fed came in April 2020, that changed market dynamics as well, helped fuel this V-shaped recovery. And it was really interesting to see our model adapt to that change in regime, because you saw it again in at the end of February, early March, with a mini, I wouldn't call it a taper tantrum because it was partially Fed driven, but when the bond market finally decided it was time to reprice debt temporarily, you've seen the most rapid movements in the yield curve. Typically the bond market doesn't move that way, and that causes disruption in the market. And a lot of the retail equity flows that have been happening because of stimulus and because of the inability to gain return anywhere else but in structured risk or in equity risk. I think all of those dynamics are playing into the market.
Yeah. Okay. Very good. Yeah, that's certainly an interesting observation on the impact that US Treasuries have certainly had on certainly the broader equity markets, and there has been that warping. That is certainly an effect that I'm sure is partly explaining, Tim, your chart that you began with. Tim, also though, looking at last year before we move on to 2021, the heat was certainly on for short sellers last year. That's continued on into 2021, but was that also a symptom of how the markets operated last year, that again, any active manager really kind of needed to be aware of, and really needed to guard against the short squeeze that we saw last year before we again come to 2021? Any thoughts there, Tim?
Yeah, I mean, one of the risks here is one of crowded trades. So with the uncertainty and there's distortion caused by the Fed and stimulus, we saw people, there was a flight to quality. So not only they went to those, growth stocks with reliable, dependable earnings, who actually, some of them benefited from, the economic shutdown, as people were doing more online shopping and delivery services and things. But we also saw that benefit large cap stocks versus small cap. So if I can, illustrate that, here I'm showing the Russell 1000 large cap index and how much it outperformed the Russell 2000. So as we look back here in 2000, we saw, a large outperformance of the large cap index relative to the small cap. It peaked in September of 2020. Then people were, starting to be encouraged by vaccinations, by a reflation or, reopening trade. And you saw these smaller companies that may be more economically sensitive start to outperform again. Well, that brief rally ended in March 11, 2021. And since you've seen the large cap, again, outperforming here. So that's one thing that we saw, and it's true most places, so over the last 52 weeks, you'd see the outperformance in gold of large caps versus the small caps here in blue. And you'd see it outperformed on the world index, the US index. UK is the exception. But then it's also, pretty much true in emerging markets, although a little bit more balance there between the two. So, it's not completely irrational. I say the largest 5 companies by market cap, used to call them the FANGs. Now I guess we threw M in there for Microsoft, so it's an unpronounceable FANGs. It hit the highest weight in history during 2020. They were almost 26% of the total weight in the S&P 500 in January. 26% in 5 stocks. It's a crowded trade. You hate to, follow into a crowded trade, but yet, if you didn't have exposure, you're underperforming the benchmark. It fell back to 21.7% in March this year, but since has recovered again, to over 24%.
Right.
But if you read the adage that market follows earnings, the growing weight in the S&P 500 is not completely irrational. One of my analysts took a look, and if you look at the S&P 500 net income versus the FANGs, the overall S&P 500, excluding those big 5 companies, declined 63% from nearly 280 billion in the second quarter of 2019 to under 103 billion a year later. On the other hand, the FANG's earnings grew from 38 billion to 40 billion, so they held in there, which was from under 12% of total S&P 500 earnings to 28%. And by Q4, their earnings nearly doubled to just under 80 billion. Now, I'd say, if there's an irony in the market today, it may be that traditional assets that were viewed as safe, such as large cap stocks and those with reliable growth rates and things like long-term treasuries, they're in bubble territory. The irony is they may now be among the riskier investments.
So that creates a dilemma, as you say. What were maybe previously thought of as flight to quality trades, could actually become they're so extremely valued now that there could be a risk that those stocks start to retrace slightly. Farian, how do you think about crowded trades in your models, and just again, given that we've started to see, as Tim's alluded to, that shift from what was a period of dominance in growth stocks last year, and now coming back again through July this year, how do your models avoid getting caught in those crowded trades that there may be as a result of those kind of dynamics playing out?
Yeah, it's a tough one. I think every active investor is grappling with that. A couple things that we do, we actively try to avoid whipsawing ourselves because we have more of a long-term holding philosophy. We personally find the volatility of a factor inversion or macroeconomic factors driving that factor inversion to be pretty hard to model. And so for us, the fundamental diagnosis of this, investors are basically stuck between what we would call a rock and a hard place. You have high duration equities, we're talking about FANG, but even further on the spectrum, and they've often correlated with what we would characterize as dominant disruptive technologies. They've delivered huge revenue growth, and as Tim highlighted, real earnings growth as well. We just saw yesterday, with the coterie of FANG earnings, the earnings were just absolutely unbelievable. Now the issue is that the duration for these assets is arguably dangerously stretched, and so the sensitivity to any type of raising rates is perilous. On the other hand, you have what otherwise feels cheap, tends to be cyclically rebounding, deep value. They often correlate with your old line economy. These are the buggy whip style exposures. They have more forward-looking sensitivity to the prospect of robust economic recovery. And understandably, when you do a quantitative study in an economic cycle, these value securities do tend to outperform to the first derivative of GDP growth. Now the difficulty for the active manager is you're trying to wrestle with these two forces, try to build a portfolio that's effectively sourced between the two piles. You have on one side, within that high duration camp, a lot of unfounded and often extreme multiples. These are often very innovative and growthy companies that, through no fault of their own, besides how expensive their currency is, they have a very narrow path to really generating excess returns, unless the circumstances remain, just right. And on the other side, you have, a set of securities that you could call float zam, value junk that's bound to sink, with any type of disruption to the economy. And the logical all-weather approach, outside of trying to time these types of inversions, is to pick the winners from each pile and hedge the losers.
Julia, I was just referring, Julia, quickly there to some of we saw bumper earnings from Google, well, certainly from Alphabet, from Microsoft, Apple. They've all had price upgrades as a result of those announcements. It's really again a bumper period for these global behemoths. Julie, what do you make of what Farian was saying about avoiding getting stuck between a rock and a hard place, and making sure that you are able to discern when to go long in the right areas in respect to growth, without getting caught that you're at the top of that value zenith, as opposed to then obviously going short areas where you think maybe some of these stocks are actually overpriced and are due to be recorrected. But how are your models ingesting all of that data and that reinforced learning, really kind of making sense of what we're seeing with these huge huge valuations and yeah, just this dominance that we're seeing.
So our model we have two strategies. One that trades broadly the S&P 500 futures, and then we have another model that trades European carbon credits, using the same model platform, but they're different models in that they ingest different data sets. The S&P model is designed to scale in and out of the market, long 100% or long short 100%, or degrees in between. And so what we see with our model is obviously it's looking at millions of views of the market as it's designing features and then weighting those features in an optimal way to determine the degree of risk that it should take in those allocations. And so what we observe is that in higher areas of turbulence in the market, our models, actually the signal seems stronger and it will trade more aggressively. But when it's noisier, like for example, in markets like this, where you have just a complete upward march with maybe a few days of volatility, it will moderate risk because it's the objective is to maximize compound return, which is creating the optimal path of the portfolio to both generate that return but protect the gains that it's received from its prior trades. So that natural risk moderation as information becomes more noisy is a natural product of the strategy, which means that we don't have to rely on predicting regime changes or putting artificial constraints on having exposure to the market, because the model is designed to trade that in a way that will literally reduce risk or reduce the allocation in those environments. And it's very effective. If we have time, I can share a chart of how it trades.
Yes, and I thought what was interesting was Tim, one of your earlier charts looking at the MSCI index. So looking at things from a global perspective, this isn't, we're not just seeing, of course we're talking about these huge US tech stocks that are just turbocharging US equities at the moment, but you see that magnitude of growth even more so when you showed us your MSCI chart. I think it was almost an order of 6 times magnitude compared to US, the Russell 1000 you were showing us, which was I think around about 3 times if you look at the size of that peak. So this is a global phenomenon as well, and so how should, Tim, active managers best think about their strategies to really make sure that they are well equipped to handle the current conditions before we look ahead into next year, and avoid those periods of extreme valuation at a global level, not just a US level?
Yeah, it is a dilemma. I mean, most long short managers don't have a tool like Julia does, very adaptive to the market. So I'd say, look farther afield. Those with broad diversification might be able to avoid some of the short squeezes that have happened in the past or might again in the future. Especially if the Fed, withdraws some support here, avoid some of these extreme valuations. It is a very narrow leadership right now. If you think about the effect of a cap-weighted index, the index itself is up more than the market cap of all the underlying constituents themselves. I look at this narrowing leadership during the last 4 weeks, only 35% of S&P 500 constituents have outperformed the index itself. So it's making it more difficult to beat the market. especially
Right.
cap-weighted indices. So I'd say one advantage of running a long-short strategy versus long-only managers is to be able to avoid the most crowded trades and to seek out absolute returns versus returns against a benchmark.
Right.
So, I can show a couple things here. So this is looking at the concentration of the FANGs again, increasing. So this was prepared by one of my senior analysts, Tejinder Dhillon. I think it illustrates the dominance of these largest companies clearly, but he's part of my team that we call proprietary research. We put out reports. These are a couple screenshots from that. So I'd say, look farther afield. If you look at the forward PE ratio of, say, the S&P 500, it's at about 22 times. It's only 17 times if you look at the mid cap or the small cap indices. Look at Europe. No matter where you look across Europe or the whole world index, every one of those has a forward PE of a much lower than the S&P 500. So if you have the ability to look a bit farther afield, that may be one form of protection.
Yeah, absolutely. I think it's that's a very interesting chart you were just showing us there. I'll just let the audience know that Julia was actually very, very generous joining today, because she is actually traveling, and she has now had to go through the departure gate. I think it's fair to say. So Julia will not be doing the last 20 minutes of the panel, but it was great to have her on board. And I know that there's a question for Julia, so forgive me, we may have to just skip over that one, I'm afraid, but we will make sure that we share everyone's details at the end. Just Farian, do you want to? I don't know, Tim, if you could bring that chart back up. I'd like to see whether Farian has a quick thought on that before I start to look ahead at what we can expect going forward. Tim, I don't know if you could bring that back up. Oh, there it is. Yeah, yeah. Farian, I just any kind of any takeaway that you would point to? Again, just looking at the world index there, just looking at 15.5x price earnings, pretty high compared to yeah, certainly Europe and the UK. Yeah, I mean, again, that's just again maybe symptomatic of this period that we've been trading through over the last 12 months.
Yeah, I mean, it's been tough. There's a section of value-oriented managers that have been pounding the table on EM and, to a lesser extent, Europe, but it's been kind of like waiting for Godot, right? This entire cycle with just US outperformance compared to any type of mean reversion. So part of that you could argue is macro driven, but part of it is also, where's the earnings growth? Where are the most dynamic companies? They tend to have been growing in the United States and on a secondary level in China, but that's kind of a separate can of worms. So it's a little harder than just saying, Nordic countries or mainland Europe is relatively cheap, or even mid caps are relatively cheap. A lot of the dynamism that historically drove earnings growth in small caps has been pulled into the private markets. So public market investors in the Russell or in the mid caps don't necessarily have access to that. And so the question is, what is driving that forward multiple? Is it a valid representation of quality of business, and we kind of see that in the earnings power of FANG that we talked about earlier, or is it a stretch valuation? That's really where the rubber meets the road.
Yeah, absolutely. Yeah, I think what I'd like to do is now move to looking forward. And Tim, again, your charts were suggesting that we're starting to see maybe a flip-flop from growth to value back to growth currently. Again, we're seeing these huge earnings reports coming out. Is this likely to be now a period over the next 12 months and beyond, where we actually start to see maybe a switch from one to the other as growth and value, just basically move in sync. Actually, I just wonder how you see that dynamic playing out. And I know that you have a particular economist that you like to refer to, which I'll allow you to share with the audience here.
Yeah, so I'm a big fan of one of my most favorite and clairvoyant economists, Dr. Ed Yardeni of Yardeni Research, and he wrote at the end of June, slower earnings growth may benefit growth stocks relative to value stocks. It becomes scarce, more expensive. But tightening monetary policy would favor value over growth. So he concludes that we expect a continuation of the bull market, but with ongoing rotation between growth and value. So from what I've seen, I agree with that. I see we kind of flip-flop around here with no dominant trend. So my advice to hedge fund managers would be to position your portfolio to do well under both scenarios if it's possible to do that.
Absolutely. And again, I think that would really kind of stress back to Farian, your point earlier, that this is then when the active manager really comes into their own, which is to really identify those opportunities where you really are able to determine where best to go long and really, avoid those extremely valued growth stocks, as well as those maybe dead in the water value stocks. So do you think, Farian, if we are going to see that rotation between value and growth, that this will actually play into the hands now of active managers who are really able to demonstrate absolute returns, not relative returns?
I certainly think it can, as long as the behavioral incentive to chase, or the FOMO, is flushed out. And I think we saw some of that in the first half of 2021, partly with the spectacular swaps blow up that was highlighted in the press incessantly, partly with some of the meme stocks, partly with the major growth inversions, specifically in May of 2021. So I think that acted as a good reset button for what otherwise felt like growth at all costs. You started seeing just these kind of ludicrous estimations of or valuations of securities on 2030 earnings, things like that. That has been flushed out a little bit, but it's rearing its ugly head. But to your point, yeah, I mean the active long short manager historically might have been somewhat duration biased, in the sense that if you're long quality and short junk, if you can think of that as an archetype for a long short portfolio, there's an inherent duration mismatch in that, and specifically in today's market, given how expensive quality has effectively been. And that's especially exacerbated by the asymmetric dynamic of running a successful short book versus a successful long book. That's always been there, but when you have junk rallies, irrational speculation, manipulation, meme stocks, whatever you want to call it, it becomes really highlighted. And I think managers have grown wise to that, and they're doing one of two things. One, they're getting out of shorting, which has an interesting kind of recursive element to it, in the sense that it might open up opportunities. Or number two, they're thinking about that basis mismatch, and they're thinking about the asymmetry between long and short portfolio more carefully than they probably otherwise would have.
Well, let's expand on that a little bit with the short squeeze that we've seen this year with GameStop, with these other meme stocks that active managers now have to contend with, Tim, a growing number of retail investors, day traders, kitchen table traders, frankly, that are using these chat rooms. You're seeing these incredible manifestations of where certain hedge funds really did get squeezed hard, regardless of whether that was the right call or not. You know, this is really kind of worried some hedge funds now as to really how they think about the short side of their books. Do they need to scale that back? Are they worried that they're going to be hit with, again, another GameStop incident? Is there anything that you're doing or anything that you're seeing that can help managers think about this, and any kind of indicators that you're using to really guard against this squeeze, where, you know, it can become an extremely costly trade, even though it could be very much the right trade to have on the book?
Yeah, it's a tricky one. We've never before seen this sort of gamification, you know, of the markets on the short selling side. So, you know, but you want hedge fund managers to be able to, you know, kind of not let the short side kill their portfolio. And you don't, I think, necessarily want to abandon the short side and be exclusively long during a period of turmoil and run an unhedged portfolio. But we do have something that might help inform the short side of a portfolio. We built a short squeeze indicator a number of years ago, and it seems to be especially effective, you know, throughout this period. So we found that, you know, common ways of predicting a short squeeze, like days to cover, doesn't really work. We also have to consider factors like volatility. What's going to kick off that short squeeze? So as I looked at our short squeeze indicator, you know, a day or two ago, I say, yeah, the meme stocks were well represented among the highest percentages of probability of being squeezed. You know, we found GameStop and AMC and Nikola all within the top 4% in terms of riskiness. But, you know, so are companies like Virgin Galactic and Plug Power and MicroStrategy. So, you know, to avoid being squeezed, you know, a tool like a short squeeze indicator might allow you to run a short side of a portfolio and avoid some of those most severe squeeze candidates.
Barry, any thoughts on that? Just maybe just in relation to the squeeze, and does it really also imply that perhaps market timing is more important perhaps now, and certainly underwriting?
Probably. You know, our perspective has always been that shorting zeros is an extremely risky proposition. You know, not only do you have to be right on your thesis, you have to be right on your timing. You have to manage your theta, which, you know, in a you know, more competitive borrow environment means that you can be right but still not make money. And of course, the portfolio asymmetry that we kind of touched upon a little bit earlier. So, you know, us personally, when we think of long short constructs, we think about it within a style factor constraint sense. And again, that's more maybe a quantitative or a systematic approach rather than the fundamental philosophy that has that quality junk, you know, mismatch we kind of talked about earlier as well. That being said, you know, because markets are reflexive and because, you know, short interest is, you know, quote unquote throwing in the towel, I think if you look at average constituent short interest within S&P 500, it just continues to plummet. You know, that might portend greater opportunity if these kind of tectonic shifts do shift. And everyone says, you know, when rates normalize, then, you know, these zeros will become zeros. But I think one of the key takeaways from, you know, meme stocks and short squeezes like that is that sentiment is more important. You know, having a pulse of what that means through these different and novel information dissemination channels, whether it's Twitter, Reddit, what have you, is important if that's going to be the game that you're playing.
Yeah. I just wonder whether to either of you, there could be risks, but also opportunities for stocks that suffer credit downgrades potentially over the next 12 months, because again, there's been so much government support, central bank support during the lockdown, during this pandemic, that there are going to be lower value companies, overly priced growth stocks that perhaps, you know, have been trading on the fact that there's been so much support, so much liquidity in the market, that let's just say there was, an incremental rate hike, they could really, they could suffer. That could have a real kind of impact on their balance sheets, and suddenly, we start to see an increasing number of credit downgrades, bankruptcies even. So, I mean, does that create an opportunity, Farian, for maybe the short side of the book, if we start to see more of these credit downgrades?
Well, it has to. I mean, we're in an environment where the most speculative, equities are accessing capital markets through their stock, let alone, issuing high yield. And that just tells you where, the spectrum of risk appetite is. And so as that normalizes, it would pretend that this stuff gets flushed out of the system, rather aggressively, and potentially rather profitably if you're looking to short. But again, it comes down to a timing dynamic. It comes down to a macro dynamic, and it comes down to an ability to withstand, what otherwise would be a pretty irrational move. But yeah, I mean, like just looking at high yield OAS might be a good indicator for when things could potentially crack. If, again, timing or catching those knives is kind of within your skill set.
Yeah. Tim, I think an important question now then to ask is have we gone past peak earnings growth? Is this period now, Q2 21, will that represent peak earnings growth? And are we likely to see a retrenchment, a sharp decline potentially in EPS going forward? I know no one has a crystal ball here, but I just wonder what your data is suggesting in respect to whether we are at peak earnings growth right now.
Yeah, so my team does look at that. So we track earnings season. We look at all the analyst estimates for each of the constituents and say the S&P 500 and what that implies. So my prop research team has put this together, which shows that, this is going to be peak earnings this quarter. So you can see here with both EPS, and revenue peaking around here. So I pulled this from yesterday's report, so it's very current. The implied growth rate for earnings for the second quarter is 79.2%. So easy year-over-year comps. Think about where we were last year, hard economic shutdown. But look how this decelerates quickly, to under 28% in the third quarter, 19%. So by the time we're in the first quarter of 2022, 4.1% growth. So who knows what the market reads into that as they see a sharp period of decelerating growth rates. But yeah, I'd say this quarter is one of peak earnings.
And Farian, are you factoring that into your models? And when you're looking at again how the market could potentially play out, and just of making sure again that you're really kind of optimizing the performance of the portfolio. How are you thinking about that? I mean, those are quite stark numbers. 79%, falling to 4%. That's a pretty stark. If it happens, that's quite a drop.
Right, and it's also constructive to look at this on a 2-year stack because, as Tim mentioned, the base in 2020 was so depressed for a lot of these companies that it's a little bit distortionary. So looking at 2019 versus 2021 growth, and you're seeing that play out somewhat nicely in a lot of earnings that are coming in. I mean, that isn't germane to how we think about things, but I think the key point here is, as a deceleration occurs, is this going to be a smooth landing, or is this, as Ray Dalio would call it, a beautiful landing, or beautiful deleveraging, or will this be a bumpy ride, given how sharp it could be? And I think that's going to play back into the dynamics of where valuations kind of continue to either accordion up and down, how that growth value dynamic kind of plays out, and what ultimately the Fed thinks is transient versus stubborn inflation, and how that causes them to move their posture.
and I mean, is there a threat, do you think, Freya, that we could see secular stagnation? Could that happen? Again, I don't know whether that's a conversation you're having with your team, but I just wonder what your thoughts are on that.
Well, it's so funny. The first few months of the year, inflation was probably the most, stylized word in all of, financial media. You had reports about used cars and semiconductor shortages and, supply chain logistics and all this causing, price inflation. And now, just in the last 6 weeks or so, the D word is starting to rear its ugly head in deflation. Look at where real 10-year yields are currently on in the U.S. Treasury market. They're below Japan, and Japan has been your poster boy of secular stagnation. It's kind of ironic because Larry Summers has been, rather vocal about his worries about what fiscal and monetary could portend in terms of inflation, and he's the one who has popularized secular stagnation, and it seems like it's kind of rearing its ugly head again into the vernacular. But these things go through their cycles, and it tends to be exacerbated one way or the other. But it has to be a threat that people think about, which is there's been unprecedented stimulus, and yet rates are absolutely stubborn. And we'll have to see how that factors into things like PCE in the coming months.
Yeah.
But keep in mind, I'd say the Fed is distorting that a lot too, with buying $80 billion a month in treasuries and another $40 billion a month in mortgage-backed securities. I'd say that yield curve is partially a symptom of that rather than necessarily a sign that we're going into stagnation.
Yeah. Are there any other parallels to draw or any insights that we can take, Tim, from previous periods of peak growth? I don't know whether your data sets have shown any particular patterns or any insights you can maybe glean from historic data that might inform again how how the next 12-24 months may play out.
Yeah, so not a lot of great examples of finding peak earnings at this extreme level. Maybe something out of 2008. The reflation trade, it was a flight to junk, but then that sort of reversed. I have looked at periods of prior sort of taper tantrums in case, the Fed's done a better job this time around in terms of communicating their intent and being transparent. But certainly markets never like periods of sort of Fed tightening. So I did look at some periods of prior taper tantrums. I found 3 since 2013. And in each of those, I looked at our different model performance, and quality consistently did well. So I'd say stay positioned for a flight to quality, if anything.
Yeah. And Farian, would you, just before I come to the last question, I just wonder whether you've been surprised at all by the extent to which value has doggedly underperformed over the last 18 months, and whether that's something that, again, we've seen the worst of it, and we will start to see now a flip between the two, or if we are going to see that drop off in earnings going into Q1 next year, could that be the momentum then that we need for some of these value stocks that have so much underperformed to really start to find a bit more momentum in the market?
I think it's important to kind of set your initial conditions a little bit. And so the way that we think about it is, what is value meant to describe? Are we talking about Fama French price to book ratio? And the problem with the classic canonical quantitative measure for value is the role that intangibles have increasingly played in the composition of the corporate sector and U.S. equities writ large. And so with that kind of, you have this deviation from what the metric was supposed to proxy for, which was quote unquote intrinsic value through book value, and that was perfectly valid in the time of Ben Graham and Mills and things like that. And it's become increasingly less valid in the time of intellectual property and increasing return phenomena and things like that. But setting that aside, if you properly accounted for that, and there's been some interesting research by like Lev Baruch, for example, that kind of looks at that, and that helps ameliorate some of the underperformance of value versus growth, but it clearly doesn't do all of it. It's maybe just a portion of it. So what drives that dilemma? And if you were to sublimate it to its principal component, probably rates. If rates rise, like, are we going to expect to continue to have stocks that trade at 30 times revenues? Probably not, because duration will take a hit, and and that will trickle down through the entire kind of risk curve, and that will be value's time to shine.
Yeah. Right. Sure. I mean, yeah, there are certainly a lot of considerations, and I think it's really how we see what the Fed will do going into 2022, and whether the extent to which, interestingly, we have seen Chinese regulatory tightening. Could that, I don't know, be reflective of what we might see for the FANG stocks going into 2022? I don't know whether either of you have a view on that at all.
Tim?
Yeah, so well, I'm in no position to give investment advice, but looking at our current and historical data, it suggests to me that position yourself for a period of turmoil, uncertainties, maybe broaden diversification a little bit more. So I just reiterate to attempt to avoid some of these most crowded trades and stocks that they look like are in bubble territory. Avoid the fear of missing out. Those with extreme valuations. I'd say also try to dodge negative earnings surprises and dangerous balance sheets and low quality, because during other periods of uncertainty and taper tantrums that I've looked at, there's a flight to quality. So, avoid some of the low quality stocks with stretched balance sheets.
Yeah, Farian, would that be factoring into how you're looking at the next 12 months and the kind of questions that you're asking internally with your team as well, that in terms of how you think about it, both on the long and the short side? And again, just to kind of reiterate the title of this webinar, to avoid getting crushed.
Yeah, I would say 3 canaries in the coal mine. One, kind of what's happening in the most speculative portions of the market, call it the post-SPAC complex, where, partly because of the loose oversight rules around projection, you had some really outlandish revenue assumptions. As those things rate down, that could be an indication that, that type of complex trade is going to crack. Number 2, antitrust. We're seeing it in a completely different fashion in China than what is projecting to potentially happen in the United States. But we just saw one major deal in Aon Willis get blown up. You have the drumbeat for the variety of the FANG companies that is increasingly feeling like some potential trust busting. And the third, I would say, is just kind of keeping a sense of where this retail trading phenomenon goes from here. There was a good line, I think it was Matt Levine called it the board market hypothesis, where when everyone was quarantined, they were just kind of trading on the Robinhood apps and using their stimulus checks. Is that a transient phenomenon? Does that continue? Is this here to stay? All of those things I think are important as potential indicators for how a portfolio that's maybe positioned in that fear of missing out and that there is no alternative might be susceptible to a changing tide.
some great insight. Yeah, some great suggestions there on what to think about, Farian. And I mean, just as a last 30 seconds though, Tim, should ultimately, as you say, the value factors and models really just did not perform last year. So just last thought from you though, Tim. In this period of uncertainty, should again systematic managers just not give up on their value models, but maybe just adjust them somewhat, and really kind of position for that uncertainty, but really not give up, even though it was a bad year last year.
Yeah, so it depends how you define value stocks, as Farian has mentioned, and I'd say, yeah, don't give up on it, but I'm not saying just like go out and buy the value index or the constituents there. But think about companies beyond the big five that might benefit, from maybe improving areas of the economy. Auto parts, and certainly done well here with car shortages, and so there are pockets of undervaluation. And I'm saying, just avoid the bubbliest areas. And like Farian said, that the biggest indicator of some bubbles in the market are SPACs. If you look at the vast number that went public and the massive amount of monies that they got as blank check companies, certainly an element of speculation. So I think there are pockets of valuation rather than buy broadly, but I think that's where the active manager can show his value.
Absolutely. No, I think that's very well said. And again, the SPAC point, very well noted. And so much for managers to think about. But I think with great uncertainty comes great opportunity, and I think that's a positive for any equity long short manager to think about over the next 12 months. It's been great getting these data insights from you, Tim, and Farian, being able to articulate how you're thinking about your strategy and the way that the market is behaving today. I think there's an awful lot to be mindful of, but feels like an exciting period nevertheless. So I think we'll all be watching carefully, Tim, for whether those earnings figures, those growth figures really do fall off a cliff as we get into Q1. I think that'll be very interesting to look out for. So thank you very much indeed for your time today. Really do appreciate it. And many thanks as well to the audience for today.